On China, because that's been at the epicenter of quite a few of the movements, especially since the surprise devaluation of August of last year. Could you just share your views as Chief Economist and co-chairman of GaveKal Research, being based in the region? Could you give us some insight as to where you think their economy is going and the impact it can have on global capital markets?
Yeah, I'm very glad you mentioned that, because especially in the context of what we were saying earlier about the Fed, there was a lot of concern a month ago, and actually going back really a year and a half ago, with the start of the so-called taper tantrum, when the Fed was talked about withdrawing monetary accommodation, that it would be a tightening of American monetary policy that changed the financial environment. But the reality is that over the last 6 months, in my view, there's only really been one problem for the markets, and that has been China. That has been much more important than anything going on in monetary policy in America or here in Europe and so on. Now, the shock from China that really started last summer in June and July had two parts in it. One was the slowdown of the Chinese economy and the weakening of demand for commodities and so on. The other was the surprising inability of the Chinese policymakers to deal with it. In my view, and that of my colleagues at Dragonomics in Beijing, it was the second part, the policy shock, that was much more disturbing to the markets than the slowdown in the economy. The slowdown in the Chinese economy is something that certainly we saw coming years ago, literally, and it shouldn't have surprised anybody who has followed the Chinese economy closely. And the government knew it, and the government was actually seeking a slowdown. The real shock, which, as I said, started in June and then really culminated with the devaluation in, I think it was the 21st of October, 21st of August, was that the Chinese policymakers, who everybody had faith in, everybody really lost that confidence. People believed that China, whatever its political problems, at least had an economy that was run by competent technocrats. And suddenly we began to question, A, were these technocrats competent? And secondly, were they really in charge? Or were the real decisions being taken by politicians who didn't understand markets and so on? So we had that China shock. By late September, early October, I think they had recaptured control of the currency in particular, and markets calmed down. But now we have Act Two. Exactly the same thing has been repeated. First with the stock market, then with the collapse of the currency in the first week of 2016. As things look to me now in the second week of 2016, I think they're regaining control, and the situation is calming down. But that is actually the crucial issue. If the Chinese can regain control, I'm convinced that the world can live with tightening Fed interest rates and so on. But if they can't, that's really the big risk in the world economy.
So what signs should we expect on that? Just market stabilization, or
I think the crucial sign I think the crucial sign is a market stabilization, but not in the stock market, but in the Chinese stock market, in the Chinese currency market. If they can get the currency, if they can persuade, because actually the currency has not fallen that much. It's only depreciated about 5% against the dollar, and actually less than 2% on a trade-weighted basis. If they can persuade the world that they are managing the currency in a responsible and capable manner, that I think is going to be the key.